Howdy, Jacob here. Today we're looking at Ball Corporation in the containers and packaging industry. $20.6 billion market cap on 24.5 enterprise value. Such a large company for something I've never heard of. All right, so they supply aluminum packaging products for beverages, personal care, and household products internationally. And PE looks incredibly low with pretty low growth, not terribly low though. I mean, this is pretty much growth with inflation, maybe even a little bit more, with gross margin very consistent in the 19% range, operating margin also very consistent, 10% range, with a dividend that has been increasing a little bit throughout the end of the 2010s and beginning of 2020s. Return on invested capital very poor, so it makes sense that they're paying a dividend. So let's look at that balance sheet. 695 million cash on hand with 7.5 billion long-term debt, a billion short-term debt. So they actually don't have enough cash to write off all their short-term debt. They're definitely going to want to refinance that, and 7.5 billion in relation to their free cash flow is a lot. Okay. So they don't even make $750 million in free cash flow over the last 5 years. They've made it two years in the last 5 years, but they've averaged well below that. So well over 10 years of their 5-year average free cash flow is in long-term debt, which is a concern. You have to think about debt similar to the way you think about your own situation. I mean, obviously, with a mortgage, it's understandable to maybe have a 10 times your free cash flow or your earning power in debt, but it's again due over 30 years. Most corporate debt is due in the next year, 2 years, 5 years, 6 years. You really don't see much beyond that, and so to have 10 times that means that they could pay 100% of their cash that they make in free cash flow to minimizing debt, and then even if this were all due in 7 years, at the end of 7 years they'd still have 3 years left to do. They'd have to refinance it, and so I mean, companies that are in a lot of debt, it dwindles their growth because that means that they have to use that cash flow to go towards debt reduction rather than share repurchases or dividends, or more importantly, reinvesting in positive acquisitions. And so going into debt can create and leverage growth exponentially because, again, you're using other people's money to grow. But then it gets to a point where your debt is so high that you have to really focus on paying that down, and that's going to slow your growth. Um, and so just keep that in mind when we do this analysis. But the net, I mean, their operating margin looks way better than their free cash flow margin, so I don't necessarily like that. But let's start making some assumptions here. I would say growth probably with inflation. I mean, I don't think it's going to be higher than that. A terminal P and price free cash flow of 13, below market average, because I mean they are a huge company, but really bad returns on invested capital. And I mean, I just don't think it's a fantastic company that I want to pay a premium for. So 5%, 4% for margins. That payout, I didn't actually look at that. So 252 million paid out on their dividend. And I mean, they can't afford that. Their earnings have just been really all over the place the last couple of years. But even if we look at like mid 2010s, that is about 30 to 50%, maybe 40% of their free cash flow over here. So they can't afford it. I don't want them to be increasing that too much because they're just doing a lot here. I just want them to figure out what they're going to do and just do that consistently. There's just a lot of reinvestment, a lot of sell-offs, a lot of, debt. It's just very confusing. And so companies that are using cash flow very inconsistently make it a challenge for me. I think a lot of people just see this operating margin and growth very consistent, and they like that, but then they don't dig deeper into the numbers and realize that it is pretty inconsistent on the things that you should be looking at. And so when it comes to, I didn't even look at it, share repurchases, 1% is about 200 million. That's a lot. Let's do 0.5%. And it just looks expensive here. The capital allocation here is, that's way too much. Capital allocation here is really using maybe 15 to 20% of their money on share repurchases, 40% or so on their dividend, remaining about 50% to pay reduce that debt figure and then maybe make some acquisitions that make sense, reinvest back in themselves. But we're leaving a good amount for debt reduction because they have so much of it. So that's going to hinder your ability to use that free cash flow to increase the size of your business. You're really just going to de-lever yourself, make yourself a safer investment from a balance sheet perspective. Anyways, like I said, has to fall quite a bit before we get the return we're looking for. I don't see myself doing a review here anytime soon, but I hope you enjoy it. You have a great rest of your day. Thank you.